All right, let us discuss about some standard business terminologies. So, in business or economics, you'll see these common terminologies. The first one is cost. In business, cost refers to the total expenditure incurred by a company to produce, sell, and deliver a product or service. That is the definition of cost. And cost can be classified as a fixed cost, which do not change with the level of output, and variable cost. And mathematically, cost generally fixed cost plus variable cost. That means the variable cost vary directly with the production level. For example, fixed cost is, for example, every month you may pay a fixed amount of rent, right? Let's say, assume that your company pay, let's say, $3,000 cost, that is the rent, but the production, depending, for example, whenever you produce more items, you'll pay more. For example, you'll pay more electricity bill. For example, this may be for example, for, let's say, 100x, that is x, that is a variable, right? This is C as a function of x. The fixed cost is as it is, but the variable cost is, whenever you increase your production, then the cost will increase. So that's why the variable cost is depending on some variable, but the fixed cost is just fixed. For example, if you produce here, for example, one item, your rent is okay, 3,000. This is an ideal example. Then one item which is equal to 3,100, and so on and so forth. So that's why a cost is a sum of fixed cost and variable cost. The other important terminology in business is revenue. The revenue, also known as sales or turnover, is the total amount of money generated by a company from its business activities. And the income may be from selling goods and service to customers. Service, for example, hotel service. That means, for example, if you are a hotel manager, you are controlling all the income or the revenue that the hotel generate every day. So that is the revenue. For example, if you are an employee of a big company, maybe the company sell a car, for example. How much money do you generate by selling a single car, and so on and so forth, 2 cars, 3 cars, and so on and so forth. Then revenue is given by price times item. That is, in business, we just use small letter P, and the item is X. So that is the price times X. For example, if you are working for a coffee company, for example, a single coffee, let's say price is, let's say, $5, right? And if you sell 200 cups of coffee, then the total revenue for selling the coffee is The price is $5 times 200 coffees, which is $1,000. That's why revenue is a price of the item and X is the number of items. How many? If you just, for example, this one, if you just sell 200, then the company generates around 1,000 for selling 200 coffees. So that is the revenue is mathematically price times item. The other one is profit. Now, profit is a financial gain realized when the amount of revenue gained exceeds the expense, cost, and taxes involved in sustaining the business activity. It is calculated as revenue minus total costs. So in order to get profit, your revenue must be greater than your total cost. By the way, as a business analyst in the future, your main goal is to bring profit to your company, right? Profit, that means you have to minimize the cost and, increase the revenue. So that will be the profit. So profit is the revenue minus the total cost. So profit can be further classified as gross profit, revenue minus the cost of goods sold, operating profit, and net profit. So total revenue minus all expenses, and so on and so forth. But profit is a key measure of a company's financial health and its ability to generate value for its shareholders. Generally, profit is, the revenue minus the total cost. And we use this formula on this section in order to find the profit and so on and so forth. Generally, we use the capital letter profit as a function of item revenue minus cost function. That is our mathematical, expression for the relation between profit, revenue, and cost. In the next video, I'll come with the definition of marginal analysis.